Hi there everybody, this is Morris from San Jose Options, and today we're going to be talking a little bit about the long butterfly option strategy. So over the years this has been one of my favorites. Typically I use the unbalanced butterfly style or a broken wing, but first we're going to talk a little bit about your basic at the money long butterfly. Okay, this strategy is a limited profit, limited risk strategy that involves 3 different strikes. You're going to be selling the strike in the middle. This could be constructed with calls and puts, or just calls or just puts. When you construct this spread, it's going to look something like this. And you'll buy one over here, and then you'll sell 2 in the middle, and then you'll buy one over here. And typically this will be at the money right in the middle. And the goal on this type of trade is to make money as the underlying goes sideways. So you'll be looking for something that may be forming a neutral type of channel and something that's not too volatile and kind of stays within that kind of channel as you go through time. Okay, and if you do that, then this strategy can be very rewarding. Okay, so again, this could be done with calls where you would have a long call, 2 short calls, and 1 long call here. You can also do this with all puts, where you'd have a put, 2 short puts, and a long put. Or you can actually have a put, a short call, and a long call. So there's different ways to do it. If you do it using puts and calls, then they typically call it an iron butterfly. So those are just some basic terms. Okay. Let's move down and see what else we can discuss. Okay, so when to use the butterfly spread. We talked about this a little bit, and it's if you think that your underlying asset is really going to go sideways for a decent a decent amount of time. But I'll also talk about another way to make money with this type of trade, and that's when you think volatility of your underlying is going down. So if you know the volatility is going to drop, then you can make some money with this spread. Okay, so one thing we like to do is an at the money butterfly over earnings. Okay. So typically over earnings, you're guaranteed that the volatility is going to drop on your underlying asset. Okay. So this is one of the strategies that we do sometimes in our course, and we do these butterflies at the money or slightly out of the money or broken wings over earnings. Now to do this, obviously it helps to have some statistics, and that's one feature that we actually have in our course. We have an instant back tester for you to help you with earnings that'll actually scan through them, back test and everything for you, and we could do, for example, 4,000 back tests in about 1 minute, okay, to help you pick those out. So this is a great way. Sometimes it works, sometimes it doesn't. The key is to find your underlying that tends to not move so much over earnings. So you're looking for ones that move maybe, let's say, less than maybe 5%. Okay, so if you find these symbols like Apple tends to work really well. But if you find ones that move about 5% or less of earnings, and then the volatility drops, let's say 20 to maybe 30%. IV drop over earnings, they typically make a pretty good return. So that's just another time that you might use this type of strategy. Okay, profit expectations. Your profit is going to be maximized here when you're right in the middle of that butterfly. Again, if it's with calls, it'll be right at the short call. If you're doing puts, it'll be right at that short put as you get towards expiration. Okay, not easy to do, but I mean, certainly could happen if you do a lot of them. Typically with this spread, you'll probably exit before expiration. It may not be wide enough to go into expiration unless you do a really wide one. Okay, maximum profit. Let's get into, let's see, the break evens. Okay, you're going to have 2 break-even points with this spread. So typically it's going to look something like this. You may have a 0 line that comes right through, and you'll have your break-even here and a break-even here. And then, so anywhere between this point and this point is going to be a profit. And then outside over here, which is, you know, this zone here, and then that zone there would be a loss. So you have to finish above the 0 line. Basically, all this would be profit. This would be a loss, and then over here would be a loss on the trade. And typically at expiration, it's about maybe 40% wide probability. A POP, we'll call it, probability of profit at expiration. So that's going by your Black-Scholes formula in typical pricing models using the standard deviations. Okay, so it is a rather low probability trade. The payout could be pretty high if you happen to stay towards the center of that butterfly. Let's talk a little bit about managing the trade. Okay, so obviously if you don't adjust the trade, then you could realize that maximum loss. And I'll just show you some basic adjustment maneuvers you can do. So again, let's say you have your butterfly here, and let's say you start in the middle. So this again's like your 0 line. And then let's say the underlying starts to go this way. Okay, so as the underlying goes this way, you can take some of this side off, and you can raise this leg like that, and then it's going to help flatten out your delta and help protect this side, so you don't lose all the way down here because you just raise it up to here, for example. There's different ways you could do it. You could take off part of this spread, or you can actually add to this spread, make this come down farther, and then that's going to tilt it. So it's almost kind of this tilting back and forth, and you're trying to balance that trade out and keep the delta rather flat. If the market went this way, you could do the opposite, where you could take off some of this, move this side up higher, or drag this side down lower, and again balance out your delta so you minimize your risk. So in most cases you won't realize, you know, a maximum. Most cases you won't have this maximum or this maximum, but you can certainly have some decent losses, especially if the market whipsaws around. Then you're kind of teeter-tottering back and forth all the time, and so that could be the tough part of the trade. But if it does trend one way, then you could keep doing your adjustment and have really not a lot of loss on it, which is kind of nice. Okay, decay behavior will not show up until the final month. So there is an interesting topic again about decay. When you're talking about decay rates, when they're at the money, they're actually not really that fast. Okay, so you have in this particular spread, you have your short contracts here, and then you have your long ones to the sides, where this is at the money in the middle. Okay, so your at the money is actually going to decay slower than these outside contracts. And that's what's so interesting about this spread, because you have the positive theta, and even though this is close to the money, it has the highest theta possible because it's right at the money. However, its decay rate, and it's something we rarely get into in our program, but your decay rate here at the money is slower. Okay, so you have a higher theta, so theta is higher, but your decay rate is actually slower right here, okay, at the money. And so in this case, like if you were doing an iron butterfly, you would have, again, you would be short a put, short a call, long a put, long a call, and this one here is going to be decaying faster than this one, and this one's going to decay faster than this one too. Your middle decays the slowest, but it has a higher price and it has more theta. So the overall trade has higher theta, but if you actually look at the decay rate of each of the strikes, the middle part's decaying the slowest. And so these decay first, and then you'll get this, that's why you get this thing that kind of curves down. It'll kind of curve down here because this one loses its value, so does this one. And then towards the end, the middle part decays, and then this will go up to the top part the last week or so of the trade, because this is the last part should decay with that slowest decay rate. So very interesting trade. Again, covered a lot of things here. Negative vega. You can make money on this when volatility drops. Up here too, like the one other thing you can think about is, again, the way it talks about how the time decay doesn't show up to the last month. Again, that's because this last part actually decays over here at the money. But just remember that, I mean, the trade could make money 1 month out, for example, or even 2 months out. Go ahead and test some over earnings, and you'll find out. And the reason is because of volatility, okay? So remember, with your option pricing model, the volatility is the strongest factor in that pricing model. So as volatility drops, you can actually move all the way up to the top of the butterfly really fast. You don't have to be at expiration. You can just maximize a profit or get close to it, or at least 20-30% sometimes, even if the trade's out a month or two, if there's just a collapse in volatility. So this is, the time decay thing is true, but remember that volatility can certainly play a very important role with this type of trade. So there you have it. Hope you enjoyed that tutorial on the butterfly. And remember, for more information, go to SJOptions. SJOptions.com. And we're also working on some amazing software for you guys that has tools that no other platform in the world has. So check us out and have a good night. Good luck with your trades. And thanks for watching this tutorial.